Great. Well, so let's start with our topic. Today's topic is myth versus reality. And myths arise due to a lack of knowledge and understanding. At the same time, investing is all about the future. No one really can tell the future. It's something that's unknown. So you can take those two things and put them together, and you can see why it is that investing is rife with myths. How do you combat myths? You combat myths with evidence. And High Probability Advisors is a evidence-based investment manager. Our senior team has over 30 years average experience in the investment industry, and what that means is we've seen these myths come and go, and some of them even come back again. So I think we're pretty well suited to tackle some of the myths that we're going to address today. When we looked at the people who are participating, we thought, given the broad background of many of the people, we would have a few different topics that ran a broad range of investment-related issues. So these four are the topics that we've chosen. The first one is about large-cap growth stocks and investing in that sector. This will probably be most relevant for those of you who have some responsibility over your foundation, endowment, or other pools of money for your organization. Yet it's going to also be relevant for your personal investment decisions as well. The next two subjects, fiduciary due diligence and fund brands, are most relevant for the retirement plans and those of you who have some oversight responsibility to your retirement plans. Then the last issue of fees is something that I think is relevant really across the board for any pool of money, any pool of investments that your organization is responsible for. So with that, why don't we start off with our first topic, which is large cap growth stocks. Our first slide that we're going to talk through has two different graphics on it. The one on the right-hand side of your screen shows a Morningstar style box, where it's broken the world of stocks, or at least in this case, U.S. stocks, into large cap, mid cap, and small cap, going down, and then value, core, and growth going across. On the bottom, or top right corner are large cap growth stocks. So it gives you a sense of what we mean when we say large cap growth. These are the bigger companies, and they're also the companies that are showing growth, both in terms of their earnings and sales, but also in terms of their valuations. They tend to be higher valued in terms of price to earnings multiples, or how much you have to pay for dollars worth of earnings tends to be higher with those stocks. At the far other corner, you have small cap value. Smaller companies, and also companies that tend to have more value characteristics. They tend to be less expensive than their growth counterparts. So if you think about the world with those two extremes, the left-hand side of your chart shows the returns above and below the overall U.S. stock market. And we use the Russell 3000 stocks as the representation of the U.S. stock market. How much did large cap growth stock out or underperform every year going back from 2020 to 2017, and the same with small cap value. And what you see with the blue bars is that large cap growth has performed exceptionally well over the last 4 years, outperformed the overall market by 18% in 2020, 5% in 2019, 4% in 2018, and 9% in 2017. And almost the mirror opposite to that has been the performance of smaller value-oriented stocks, underperforming year by year by magnitudes similar to, or in some cases greater than, the outperformance of large cap growth stocks. So large cap growth has been performing very, very well for a very long time. And that's, I think, the major point that you get out of this slide. But if you think about the stocks that we're all talking about, you think about the companies that we're talking about, the beneficiaries of the pandemic, that type of thing, you know, a lot of those companies are large cap growth companies. In fact, many of you have probably heard the term FANMAG, FanMag is Facebook, Apple, Netflix, Microsoft, Amazon, and Google. And we've added 2 other stocks to our list here on this slide, Tesla and NVIDIA. And together, those stocks represent about 20%, a little over 20% of the total U.S. stock market. So just a handful of stocks represent a very large portion of the total U.S. stock market. And their returns, as you see in the 2020 return column, have been just unbelievable in a year that has included a pandemic and a very choppy market, to say the least. When you bring those stocks together, the FanMag stocks plus TNN, Tesla and NVIDIA, together their returns were 67%. When you look at the overall U.S. stock market with those stocks in it, you have returns of 20% for last year. It's great symmetry, right? In 2020, the U.S. stock market was up 20%. But if you take those stocks out of the overall U.S. stock market, returns almost drop in half, down to 11.8%. These companies are the growing companies. Many of them have benefited from the pandemic, having benefit from stay-at-home work and those types of things. So, it's natural that the performance is good. You say to yourself, this is all very reasonable. Good growing stocks should perform better, right? If those companies are growing. So that leads us to our first question. And I'm going to open up the polls for this. Make sure I open up the polls correctly for this. Oh, there we go. Wonderful. So hopefully you see the polling questions on your right. I will give you a little bit of time to answer it. But I'll ask the question. Big growth stocks consistently outperform. Is that statement a myth or is it a reality? Let's take a little time. We have about a minute, a little less than a minute to allow people to respond. And everybody should respond so that you do get credit. So we're going to try to keep this open for the full time period that we have. And please respond if you'd like to get CPE credit for this presentation. So we're getting some pretty good responses in. And we have about 15 more seconds to go for you to respond. So if you can, please respond to the questions. 5 more seconds. 3, 2, 1. Wonderful. Okay, we'll close the poll. And I'll share the polling results. Polling results are that we had about 36 people say that it's a myth, about 28 say that it's a reality. So we're pretty split. All right, now let's move on then to the next slide. In the next slide, we're going to talk about what's going on, the evidence of large cap growth outperformance. And we're going to start by looking back at 3 other time periods where we've had similar tremendous outperformance by large cap growth stocks. Those time periods were 1969 to 72, 97 to 99, and 2017 to 2020. Now, you probably do remember 97 to 99, a lot of you do. That was the tech bubble. And in that period, small cap value stocks did okay, but large cap growth stocks did tremendously over that time period. The time period before that, many of you may not remember, but it was called the Nifty 50 time period, from the late 1960s to the early 1970s. And once again, it was a time period where the gap between growth and value was tremendous. All right, so we'll take those historical time periods and let's look at what happened next after those time periods. When we look at the next time period, starting 68 to 72, you had great large cap growth stock performance, but then from 73 to 79, small cap value outperformed tremendously, over 200% return, whereas large cap growth stocks were relatively flat over the time period. Likewise, after the tech bubble, small cap and more value-oriented stocks did incredibly well, over a 200% return from 2000 to 2006. But once again, large cap growth was flat to slightly down over the time period. We don't know what's going to happen in 2021 and beyond. But the point here is that during these periods, the future for the fundamentals of these companies was pretty good, but the market had already discounted how great these companies were going to be. And the end result of that is a period where those expectations were high and were already discounted in prices, and prices really didn't advance very well for large cap growth over those time periods. So valuations were a key aspect of after the gold rush, after these time periods of strong large cap growth performance. The chart shows you some of those valuations. Here we're looking at the price to sales ratio, or how much you have to pay for a dollar's worth of sales for a company within that pool of stocks. The blue line shows tech stocks, so it's the technology sector. The orange line shows the overall market, and then the gray line shows the overall market when you take out the tech stocks. The tech bubble, you can see, was an extraordinary time period where not only were tech stocks very, very expensive, but also you were paying many dollars for a dollar's worth of sales, but also the other stocks were actually relatively cheap based on this graph. They were down at the low end of their range. You look then at that correction that happened after the tech bubble burst, and those valuations came back down to something much more normal. And then you look at the end period here. We have gone through a long period here, several years, where tech stocks have gotten more and more and more expensive. So that valuation discrepancy is something that you do worry about when you worry about what's going to happen next. Once again, nobody knows the future. We do not know the future. But when we look at this, our conclusion is that the idea that growth stocks always and consistently outperform is a myth. That's supported by academic research. There is a lot of research that has gone on that has basically come to the conclusion that there are certain factors, certain characteristics that portfolios have that lead to outperformance over time. Two of those 5 factors that we've highlighted here, the first one, size, shows that smaller companies tend to outperform larger companies over long periods of time. So over the short term, it may be the big companies outperform over a few years, but over the long term, smaller companies outperform to the tune of 3% or more per year on average. Likewise, if you look at the middle bar, more value-oriented stocks tend to outperform the overall market by about 1.25% per year when you look over the long term. So right now, the opposite of size and the opposite of value has done very well. But over the long term, growth and value tend to not be tilts that you want to have in your portfolio. They tend to create risk of underperformance over time. So what does this mean for you as stewards of different pools of money that you're responsible for? The first thing that it means is that when you're evaluating your managers, when you're evaluating your portfolios, managers that are doing really well over the last several years probably have a strong tilt to large growth companies, right? They tend to be tilted in that direction, and that's why they're outperforming. Those are the factor exposures that are doing well over the last few years. But as we've seen, there's a risk that can turn dramatically, just like it did after the tech bubble and after the Nifty 50. So understanding that strong performance, that manager looking brilliant, may just be the environment and the tilts that they have in their portfolio. You want to, at the very least, make sure that you're rebalancing back away from some of those exposures and try not to have too much of that decision be driven by the short-term performance of the last few years. So that's the most important thing. And then the second thing is you may want to look at how the tilts are in your portfolio over the long term, because these factors have been shown over time to add value. Tilting your portfolio in these directions, especially for pools of money that have very long-term time horizons, should over time add value to your overall portfolio. So that's our first topic. Let's move on to our second topic. And the second topic is a retirement one, and it's about fiduciary due diligence. I'm going to start this topic by listing all the responsibilities that you and your organization has as a plan sponsor of a retirement plan. And there's a lot of them. And these are really just the categories. Below these categories, there are many, many individual responsibilities. They include different administrative responsibilities related to the plan's document, related to making sure that you follow that plan document, to regulatory oversight and filings, compliance testing, plan audits. It also relates to the investment aspects of the plan. You've got responsibility as plan sponsor over the selection of the investments, the investment policy statements, the due diligence of advisors, of managers, of providers and the fees that they're charging. A lot of responsibilities. And when you think about all those responsibilities, it leads to our next question for audience participation. So our next question, and I will open this up, is the statement, the one responsibility that employers cannot delegate away is due diligence. Is that question a myth or a reality? Let's see what your answers are. We have a little less than a minute, so please make sure that you respond. We have a lot of responses saying reality, but a few that are saying myth. So we'll see how this goes. Thirty more seconds. Once again, if you want CPE credit, please make sure that you respond. All right, we have about 10 more seconds to respond, please. Okay, wonderful. So that's it. And we had about 9% responded that it's a myth, and the remainder responded that it is a reality. So now let's talk about the evidence of this, and let's dig in first by talking about some of the responsibilities that can be delegated away by a plan sponsor. There are, unfortunately, the investment business, the retirement business has a language of its own. You may have heard these terms before. If not, I'm going to try to introduce them to you. But ERISA, the Employee Retirement Income Security Act of 1974, has different terms that they've included for different roles that advisors can have to the plan. And one of those roles is a 338 manager. A 338 manager is an investment advisor to your plan that has discretionary responsibility over the investments. A 338 manager with discretionary responsibility over the investments means that they're going to take those responsibilities off the plan sponsor's shoulders, and the plan sponsor in turn is going to still have the responsibility of doing due diligence on that 338 manager, making sure that that manager is doing their job and doing what they're supposed to be doing. Now, this contrasts to what we often see in the retirement business, in the retirement industry, which is advisors who are either brokers or 321 advisors. A 321 advisor is another ERISA term for a co-fiduciary advisor that has some responsibility for the recommendations that they make, but ultimately they're a co-fiduciary, and the actual decision-making responsibility still rests with the plan sponsor. So in this area, what we would say is that you can, in fact, delegate the investment decisions of your plan to a 338 manager, and in that way pull them off of your shoulders as a plan sponsor. You still have due diligence responsibility over the 338 manager, but the rest of the responsibilities are the responsibility of that 338 manager if they are a discretionary manager and if they accept that responsibility in writing. So that's one way of lifting some of the responsibilities off your shoulder as a plan sponsor. What's the other way of lifting some responsibility? It's by hiring a 316 administrator. Once again, this is another term, ERISA term. It is a administrator that accepts full fiduciary responsibility for the administration of the plan. Now, when I say full fiduciary responsibility, every 316 administrator will have a list of what things they're willing to take on, and you need to make sure that that list is relatively complete. But if you've got an administrator that in writing is saying, we're going to take responsibility for these things as a 316 administrator, then in fact, they can be the fiduciary taking responsibility of some of the bigger hassles of retirement plans, including approving loans and distributions based on the plan document, and signing regulatory filings, those types of things. Now, most plans have what's called a third-party administrator, or that third-party administrator is bundled as part of the record keeper. One way or the other, they can help with the administration of the plan. Those ministerial services can be provided to the plan sponsor, but it's the plan sponsor who ultimately retains that responsibility unless you've got a 316 administrator. If you have a 316 administrator, now the responsibility is to do due diligence on your 316 administrator. So now we found two ways that you can take some responsibility off your shoulders. But this leaves a question. Can we, in fact, take plan sponsor responsibilities off the shoulder of you as an employer offering a retirement plan? Well, the answer to that is fixed. The answer to that is yes for for-profit companies and not yet for not-for-profit companies. So let me dig into that a little bit. There was legislation that came out at the end of 2019 called the Secure Act. The Secure Act allow for something called a pooled employer plan. These plans have first started allowed to be offered to for-profit employers in the beginning of this year. That pooled employer plan is an improvement upon old multi-employer plans that you may have seen or heard of in the past. A multi-employer plan has been improved with the PEP by, number one, this is the first time that a retirement retirement company can, on a commercial basis, offer a plan to different unrelated employers. Multi-employer plans required the employer to be related. Now, with a pooled employer plan, that allowed for unrelated employers to come together in one plan. And then the second improvement upon it was that the one bad apple rule has been eliminated. What's the one bad apple rule? Well, in the old multi-employer plans, if one employer failed to follow the rules, it affected all the other apples in the basket, affected all the other employers potentially. With that elimination of that one bad apple, pooled employer plans now take away one of the risks of joining a plan with other employers. The pooled employer plan is managed by something called a pooled plan provider, PPP. We're great with acronyms in our business. And the PPP is the plan sponsor. They're responsible for all of the duties to the plan. And what we'll talk about what that means is that your duty then, if you as an employer join the PEP, is to do due diligence on the PPP. Otherwise, that is, the way to lift all those plan sponsor responsibilities is to join the PEP. If you're a not-for-profit, and I know a lot of the people today, have exclusively not-for-profits, this has not yet been extended to 403(b) plans, but the good news is Congress is working on an update to the 2019 Secure Act And it is expected that this will be extended to 403B plans very, very soon. So that's our hope coming up pretty soon. So this is kind of a graphic of how the pooled employer plan works. You've got an advisor that's working with each employer, helping them and helping their employees with as participants to the plan. They come together, and then that pooled employer plan, they're the one responsible for due diligence on that 338 manager, on that 316 administrator, on that record keeper. They have all the responsibility there, and the employer is just simply doing due diligence on the pooled plan provider, making sure that they've got the experience necessary to be a pooled plan provider. So the answer to this question, our conclusion is that it's a reality. The one responsibility you cannot delegate away is due diligence as an employer. However, the level of your due diligence depends on the nature of and the structure of your plan. If you are an employer that has adopted a pooled employer plan, a PEP, then your due diligence is over that pooled plan provider. If in the middle bar that we have here, the middle box we have here, if you are a single employer plan, your 403B plan, your 401k plan is just for your organization, but you've hired a 338 manager and a 316 administrator, your due diligence is monitoring them, and they're ultimately responsible for the other activities. If you don't have a 338 manager, you don't have a 316 administrator, then you've got fiduciary responsibility at a more granular level for all the different responsibilities. So your due diligence really is a function of the structure of your plan, but you can in fact eliminate a lot of the administrative duties, a lot of the fiduciary burden at a very micro level, by moving your way to the left on this graphic. All right, we've gone through two of our topics, and we're about halfway through our time today. So we'll go to the next topic, and the next topic is fund brands. And I'm going to jump right into the question and open up the poll. So here's the statement. Using popular fund brands on your investment menu leads to better participant decisions and lower fiduciary risk. Is that a myth or is that a reality? Let's see what the conclusions are. We have about a minute left. We have about 20 seconds to go. I think a few more people are left to respond. About 10 seconds, so please, if you want CPE credit, please just respond to the poll. Wonderful. Now I'm going to show the poll results. Most people thought that this statement was a myth. A few thought it was a reality. I will admit the prompt for this session actually cheated and said what was a myth and what was a reality in my conclusion. So if those of you that saw the original prompt to the session here, you probably know what I'm going to conclude already, but fund brands, myth versus reality, most have said myth, and I'm going to give some evidence, related to this. Let's dig into the details. Let's start with the idea of brands and participant behavior. Some of the big brands in the industry are Vanguard, Fidelity, T. Rowe Price, American Funds, Dodge & Cox. A lot of these fund companies are also record keepers or provide record keeping services. And they're all big brands who spend an awful lot on advertising. And you have to ask yourself, okay, Why do they spend money on advertising? The answer is because it works, because it tends to work. People tend to respond to advertising, and they tend to make decisions based on recognition of that name, of that brand. Sometimes that can get in the way of the investment and asset allocation decisions that participants are making. So if they recognize a brand of a fund that is covering a asset class that might be very volatile, very risky, they may feel that brand means that those funds are not going to have volatility or risk associated with them, and that can bias their asset allocation decision that they're making. So brands do work. People do respond to brands, and there are times when people will allocate to brands simply because of the brand or feel more confident about it instead of allocating based on the underlying asset classes or roles that those funds have in the menu. It also is an issue for you in due diligence. And this is especially the case for what's called proprietary funds. Proprietary funds are those funds that are offered by the same company that's providing the record keeping and the administration for your plan. There are a lot of firms that will offer the whole package, the record keeping, administration, and the investments. And the more money that is in the plan in their funds, the lower the cost is going to be for record keeping and for administration. And it can look to you as a plan sponsor like, well, this is cheaper for my participants, so this is better. Therefore, we should be putting as many of these funds in as we can. The one point that you need to remember when you do that is that your due diligence responsibility over these funds, those responsibilities are not reduced by the lower costs of the record keeping and administration of the plan. That subsidization that sometimes can, be a little bit muddled, in exactly what you're paying for. That does not reduce your responsibility to make sure that those investments are prudent and appropriate for your plan. This is especially the case with target date funds, and it's an area that has gotten the attention of the Department of Labor. Those target date funds are intended to be the funds that are do it for me for the participants who don't know how to make their own asset allocation decision. And frankly, most participants really don't know how to build their own investment portfolio. They rely heavily on target date funds to get them in the right place. If you remember what target date funds are, these are funds that have a date attached to them related to when a participant thinks they're going to retire. And they'll go from more growth-oriented to more conservative over time in terms of their stock bond mix. As that participant moves towards their retirement date. Those funds tend to be the defaults in plans, and they also tend to be the funds that have the most attention to them by the Department of Labor. In fact, the Department of Labor came out in 2013 with a statement that included about target date funds and how to do due diligence on target date funds, and it included inquire about whether a custom or non-proprietary target date fund would be a better fit for your plan. That communication is clear. They're saying that you as plan sponsor need to be responsible for that target date fund being appropriate for your participants, regardless of whether it results in lower fees for your plan. So, our conclusion, once again, is that this is a myth. The reality is that brand does not affect your due diligence responsibility, and it can, in fact, get in the way of good participant decision-making. They should make their decision about whether they should be allocating to small cap value, large cap growth, the overall index. They should not be doing that based on, one brand over another brand. I've been doing fund due diligence for retirement plans going back for over 25 years. And I've also looked at other providers who do due diligence on funds over time. And I have never yet seen criteria in the industry where brand name was part of the due diligence checklist over the funds. There are a lot of focus on things such as whether this fund is consistent with the plan's objectives, are the fees reasonable, is there stability and consistency in the way it's being managed, but brand name is simply not something I've seen in the best practices for investment due diligence. And likewise, I've looked at a lot of different court cases on fiduciary breaches in retirement plans, and the courts don't really care about fund brand. I've seen a lot of very well-known brands come up in court cases. In the end, this is your plan. It should be your brand. It's not about what providers you use. This is about your plan and what's the best thing for your participants. Focusing on that and not on the brands of these fund providers that you may be working with will help you over time as a fiduciary and also in helping your participants get to better outcomes. All right, so now we're going to hit the last subject that I have, and the last subject is fee transparency. And we're going to open up our final poll. That final poll is a quick, easy statement. We don't pay any fees. Is this statement a myth or a reality? I've already given everybody the idea that I've given the response and the cue for the session. So hopefully everybody knows what our conclusion is going to be on that. So we're doing pretty well. We got about 15 minutes, and we're ramping up pretty quickly. We got about 40 seconds left. All right, about 30 seconds left if anybody else needs to respond. So far, I have 100% saying myth. And I have to tell you, even though this sounds like a statement that should be a myth, the reality is I have heard many clients over the years say the same thing. I've heard it for retirement plans. I've heard it for operating funds. I've heard it for a wide variety of pools of money. It looks like 100% said myth. So let's move on and dig into this a little bit. I'm going to start by digging into this on the retirement plan side. There are different providers that every retirement plan has. Record keeper, a third-party administrator. Sometimes the record keeper, once again, bundles that administration together. There are also typically investment advisors associated with the plan. Way that you pay those providers can vary greatly from one provider to the next. Many of these providers have what's called asset-based fees, which means they're going to charge based on a percentage of the total assets that you have in your 403B plan or your 401k plan. Those assets-based fees, are mostly seen in the investment advisor side. We rarely see anything different than asset-based fees on the advisor side, but you also will see them with record keepers and TPAs. You'll see asset-based fees that will be charged for their services. The line below that, per participant fees or per head fees, is something you also see very often with TPAs and record keepers. Those per participant fees are rarely seen on the investment advisor side, but because a lot of the costs for a record keeper and a TPA is based on the number of participants, you'll see per participant charges there. And then finally, you will periodically see flat fees or base fees. You see this on the investment advisor side, sometimes with very, very large plans, where they may charge a fee for a project or a flat dollar fee for their 321 services. See it much less for 338 services. That tends to be an asset-based fee. And then you see this also on the record keeper TPA side with base fees. In fact, when you think about who the right providers are for your plan, part of this has to do with the nature of your plan and the way that those providers are charging. If you have a plan that has a lot of assets and few participants, which means your average balances are large, 100,000 or more, then having a record keeper, a TPA that charges most of their fees as per participant fees tends to be a benefit for you because you have fewer participants, larger assets. The overall effect of that cost ends up being less. If, on the other hand, you have a plan that has a lot of participants with very small balances, then asset-based fees tend to be the better way to go. So the right provider in part is evaluating how they charge their fees. The other thing you need to think about is actually physically how are those fees charged. And the last three lines show different ways that those fees can be charged. We see them charged to the plan directly, so to the participants' balances. We see this very often for the investment side, where the investment fees are charged directly to the participants. You also will see this for record keeping and TPA fees, where those charges are directly to the participants. Sometimes the employer pays these fees. Most of the time when we see that, it's typically because there's in a for-profit company, there can be tax benefits to the owners of that company, and to pay those fees directly. But more often we see that on the administrator side than we do on the advisor side. And then this idea of I don't pay any fees comes from that last row of this table: revenue sharing payments. There is a choice of funds that a plan can make, where those funds will rebate costs for certain share classes that they have back to the plan that can cover the advisor and the record-keeping fees. These revenue-sharing payments are, in fact, a cost to the plan, and they should be disclosed. They should be understood. So those are a cost. They end up resulting in a higher cost for those funds, typically dollar for dollar, for the payments that are being made to the advisor, to the record keeper, to the TPA. So it's not that if there's revenue sharing and these funds are sending money back to the plan to cover these costs, it's not that those services don't cost anything. It's that they're being paid for in a certain way. But that is still the plan paying those costs. And diligence needs to be done to make sure that those costs aren't too high. When we talk about due diligence, the Department of Labor has made this an important enough of an issue that they've actually created a fee disclosure called the 408B2 fee disclosure. That fee disclosure is required to be provided for plans and plan sponsors and also participants, and it gives how the fees are being charged, what those charges are. And if you look at those fees, you will see that the larger the plan gets, hopefully those fees go down. That is not always the case. And it's something that you need to look at when you look at those fee disclosures. Fee due diligence is something that you should do every few years to make sure that your plan, as it grows, is not paying uncompetitive fees for the services being provided. This chart here shows, using one data source, shows the range of fees for plans averaging about $50,000 per participant in plan assets. And you can see that as plans grow, the range of competitive fees goes down. This range is showing the lowest 25% of fees for that plan size to the highest 25%. And that range there goes down as plan assets grow. So doing due diligence regularly to make sure that as your plan's demographics change, you're not paying too much in fees is something that makes an awful lot of sense. Frankly, it's something that we do for free for the Bonadio group clients. We'll do a one-time fee due diligence report just to help people understand what their costs are today. So end result of this is that this is a myth. The reality is your providers are not for-profit. Even if your organization is not for-profit, your providers are not for-profit. I saw a note in the chat earlier, no such thing as a free lunch, and that is truly the case. All companies, have a business model, and it's important to understand how they're being paid. That is true for every pool of money that your organization has responsibility over. It's true in the endowment, it's true in the foundation, it's true for the operating funds that you have. So if you have a portfolio with a broker of bonds, and those bonds are being kind of rolled over time, please understand that if that advisor is not charging that broker is not charging a fee directly, they're probably charging fees for that trading that's going on. They're making money through that. They're making money some way, one way or the other. And so the end result is understanding what those costs are and understanding the nature of how people get paid is important. And that's one thing that I think a lot of people don't understand is that if you get paid for transactions, there's a natural incentive to do more transactions. So making sure you understand those incentives and that you evaluate your providers accordingly makes sense. And then once it's, again, doing fee due diligence makes sense. It should be done on a regular basis. Having that documentation is important, not just for your retirement plan, but really for the various pools that you have. Will help you as fiduciaries, as responsible parties to your organization's assets. Make sure that you're doing what you should be doing, in due diligence for your organizations. So with that, I have covered the subjects that I was hoping to cover. That's been about 47 minutes, and we've got 13 minutes left in the session. So, what I would like to do is open it up to questions. And if you have questions, I will answer. All right. So, first question is it important to have the lowest possible fees from a fiduciary perspective? What I will say is definitely not. Fee due diligence and fee reasonableness as a retirement plan doesn't necessarily mean the lowest fees possible. It means fees are reasonable in light of the services being provided. So we talked before about the idea of a 316 administrator or a 338 manager. Those responsibilities include, are greater, and so you'll tend to see charges, costs for that. Making sure that your fee due diligence is like for like is very important, and so that means evaluating versus other providers that are providing similar services. And the other thing you notice is that our chart that we showed was the lowest 25% to the highest 25%. We think that that range is a reasonable range. We aren't showing the very cheapest, plans out there, not because it isn't good to be low. It's more just a matter of fee reasonableness it relates to that area within that range. And so that's one of the reasons why we show the lowest to top quartile. You don't want to be at the high end of the range unless you're getting services that warrant that high end cost. All right, so the next question we have is, what do you consider when evaluating target date funds, and how has that changed in recent years? This is a very important question, and it relates to the fact that a target date fund should be a fund that stays with the plan for a very, very long period of time, right? Essentially, this is an allocation that strategy that's intended for the lifetime of the participants, and so you want to adopt that with the idea that it's going to remain consistent over the long term for your participants. So what do you need to focus on? The first thing you need to focus on are the same things you focus on with other funds. Fee reasonableness. Are the costs reasonable in light of what is being provided here? You need to focus on the consistency of this fund with the objectives that you have. So what are we trying to accomplish for the participants? Even what's the nature of the participant base, how much turnover is in the group, what is the knowledge base and understanding of the group, what other plans might be available to help them in retirement. Those types of things all can lead to the evaluation of that glide path that goes to more conservative over time. So fees are important. The consistency with the objective is important. The stability of the management, the experience of the management is important as well. You'd like to see this being consistent over time. Performance is something that we would not push on very, very heavily when it comes to evaluating target date funds. And that's mostly because you don't want to be caught in a buy high, sell low trap. Right? You don't want to be caught in a situation where one target date fund has more large cap growth stocks, another one has more value stocks. In the last 4 years, the large cap growth has done better. And some scoring system says, well, you know what, you should fire your large cap growth or your small cap value bias manager and hire your large cap growth manager, and you end up getting turnover, and at just the wrong time, you're buying large cap growth for your target date funds. So, I would say that instead, performance needs to be consistent in light of the environment. What is the nature of the option? What's the overall asset allocation? And is that performance consistent, within a tolerable range? And that will allow you to avoid a lot of turnover for your target date funds. I think there has been more understanding that you don't want to have turnover of your funds, target date funds. But I think the biggest thing that's changed in recent years with target date fund due diligence is the fact that it's actually being done on the record keepers' funds. Before it was just, oh yeah, no, our target date funds are handled by our provider, and you didn't think about it. I think the fact that there's more due diligence being done is the real change that we've seen over the last several years. All right, I have another question, which is, if managers overweight to large cap growth stocks are the ones that are outperforming and they are higher risk today, then how do we use performance reports to evaluate our managers and make good decisions? So this question is related a little bit to our target date question before, which is, if we, suspect that good performance comes from the leanings and the biases of managers, how do we pull those leanings and biases away when we're evaluating performance? And how do we use performance to figure out whether the manager is doing a good job or a bad job? The reality is often the performance is more related to the biases of the manager, the style of the manager, than it is to their cleverness, their ability to add excess return or alpha or value in some way. The first thing to do is to look at that portfolio and look at its allocations to understand what those allocations are. If, in fact, you see that this is a manager that has been tilted towards large cap growth, then you know to not weigh that performance very highly in your evaluation of that manager. You should be evaluating them on other things, including whether they understand the risks in this area and how they're going to manage those risks. Likewise, if you look at those portfolios and they're tilted in the other direction, then once again, you need to understand that that performance is likely to be tilted in the other direction as well, and you need to be sensitive to the idea that a little bit of underperformance in this environment may be the price we pay for lower risk in the future. It is nuanced. It is not clear-cut and easy, and I know we all like the idea of our performance reports to be clear-cut, easy answers, to questions. Unfortunately, it isn't always the case that, that happens. In fact, over periods even as long as 3 years, 5 years, I mean, we saw those numbers over 4 years, you can have those numbers significantly influenced by, those time periods, those issues. So I don't know, do we happen to have any other questions? I have one more question, and that question is, are there good fund brands and bad fund brands to have in a retirement plan? This is an interesting question in that, fund brands by themselves, shouldn't drive the decisions. Are some fund brands better than others in terms of putting in your retirement portfolio? And what I would say is that a lot of the fund brands are built around the idea that their managers will always be able to outperform. Right, so their fund brand is based on the idea that they're always going to be smarter, they're always going to be more clever, they're always going to be able to outperform. We at High Probability Advisors are very, very skeptical of that. And the evidence of that is that you look over different types of investments and you look over time, the ability to consistently outperform, is very, very difficult, especially relative to the higher fees that are paid for those active decision-making that's going on. So fund brands are typically based on this belief that performance is going to be, or this potential myth that performance is always going to be better. Even if they're able to show that the performance is better looking backwards, the reality is investing is all about the future, and you don't know what the future is going to hold for those investments. So relying on the past to help you make decisions about how good your brands are going forward, is challenging. there are some brands that are actually based on low cost rather than the brand being based on low or a performance, right? Does that mean those brands, actually low-cost brands, have that benefit of, helping you with your fee due diligence and your fee reasonableness? Does that mean that you don't have any due diligence responsibility over those funds? No, you still have responsibility to monitor those funds, make sure that they remain consistent with the role that you have them in the plan, make sure that they're invested consistently over time. But those fund brands that are more low-cost focused than they are, we can add value and we can add return, actually probably end up being a little bit of a protection in the plan. So, when I gave you some fund brand names, fund brand names like T. Rowe and Dodge & Cox are all about outperformance. Fund brands like Vanguard, they're index fund providers generally. They're all about low cost. From high probability advisors' perspective, we'd say that biasing towards low cost is going to help you with fee reasonableness. It's going to have a higher probability of giving better outcomes for participants. There's going to be more consistency there, and there's probably going to be less due diligence pressure on you as a fiduciary running your plans. So, that's the conclusion on that. And I don't know, are there any other questions that the audience has at this point? All right. Well, I very much thank you for your time today. We are going to have this continue through noon, but I just want to say high probability advisors, is about trying to make sure we understand the risks, make sure that we understand the evidence as investors. We do know that the future is uncertain, and we also know that this is about doing the right thing for your organization, doing the right thing for your participants. And, that is something that we're dedicated to as an organization. So we thank the Bonadio Group for inviting us to speak at this session. We thank you very much for your time, and, hope there's, some benefit that you got from our presentation. So thank you very much, and look forward to speaking to you again sometime soon.